Welcome, fellow traders. In this video, we're gonna be looking at the power of momentum in trading and how can you catch the momentum. And okay, by momentum it means that the levels where the market will be more active, where you can make the most profit. Okay, so if we're gonna start here, we're gonna start on a higher time frame. We're gonna go to daily. Okay, there are steps that you need to follow if you want to get this breakout momentum. Okay, if we look here on this chart here, we have first step that you need to do, or that you need to follow, is identifying your key levels. I have a video here, if you don't know your key levels well, that I dive into details of the key levels. You can check it out. Okay, so I'm also gonna explain them here. Identify your key levels. That's the first thing that you need to do. Your key levels are resistance and support. Resistance, support, resistance, so on. So these are your key levels, and that's where the magic is happening, on the key levels. So if we come here, where are the key levels? If we look, okay, you need a past key levels to identify the future key levels, or where the market is gonna react. Okay, if we look here, let's take the past. Okay, the past information. Okay. If we look here, when the market was going up here, we had this resistance. We had this resistance up here. This served us as a resistance. It was a key level before the market came here. So that served as a key level, of which it was a resistance, because the market was going up, it created a resistance, and then it went down, and then after that it went up, and then after going up it came here and it gave us a momentum of which the market came up, and then after that it came down. So the first thing that you need to do is to identify the key levels. What are the key levels? Support and resistance. Support and resistance. That's where the market, when it gets there, it reacts to those levels. That's the first thing that you need to follow on those key levels. Okay, let me identify more key levels here and what happened. Okay, moving on to the next key level. This is what happened here. We had a resistance again. The market went down and came up. When it went down, it created another key level, of which the market went up, came to this key level again, of which this was the first touch. The market came back, and on that same level, on that key level, the market managed to find a support level. And after finding a support level, what happened? The market started to go up. The market started to go up with a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And when it was moving, there was another key level here. Remember that the most important key levels are on a higher time frame, daily, 4 hours. Those are the most important key levels that you need to be looking at. Okay, when the market came here, it went out first and gave us a spike. This is a daily. It means that must have took the whole day to do the process, and then at the end of the day the market was back in this level. It means that it respected this key level up here, or this resistance. This resistance here was respected, and the market came back again. And when it came back to this key level again, of which this was a support, when the market break out, which was not much of a out, the market came back to this level, and again it played around here, and then the market played, and then okay, since the market has came here, if you look, remember that when the market is moving, you have to keep on moving on with your and updating your key levels. the market created this key level here, it was of importance as the market kept on going, because when the market get here, there was nothing else you could look at this moment. So this was the key level of which the market came and respected this resistance. Again, it was a new resistance here, came and respected this resistance, and so on. There was a new support which was created here, of which the market came and respected here, and then started to go up and then down again. So these are the key levels. When the market gets there, they start to play. Okay, so once you identify your key levels, your support, our support and resistance. Okay, we have the support, the lowest support. Okay, the most important thing to do when you're analyzing, the first thing is to draw your outermost key level, so that you can see where you are supposed to be focusing on your chart. So at this moment here, we have resistance, support, and then we have support, we have resistance, and now we know that this is our current level. Okay, so we move. And what happens when the market gets to these key levels? What happens when the market gets to this key level? This is the second step. Now we are going to the second step. What happens when the market gets to these key zones? Second step is to wait for consolidation. By consolidation is to wait for market to react on these levels. If we check, when the market reaches for this level on the second, okay, on the second touch here, this was the first, and then here this is the second. On the second touch here, what happened? The market gave something like a double top. If we go to the lower time frame, that's when okay, let's go to the lower time frame. This is what happened here. On the lower time frame, the market did what? It played around here, it consolidated at this level. By consolidation, on a higher time frame, it can be having few candles, but on a smaller time frame, you're gonna be getting a lot of candles, which are gonna be indicating, or your indicator to show you that this is a consolidation or a ranging. Some they call it ranging level, some consolidation. So when the market gets to the key level, remember that you wait for the consolidation and see how is it reacting. The purpose of waiting for the reaction is to see if the market is going to break out or fail to break out, because the breakout here I'm talking about when the market is coming up here and consolidate here. By consolidation, it can be in form of breakout and a retest, and then market came back here, and then after that it started to go up. Okay, or when the market do something like this, when it comes to this resistance and start to fail and go down as it is right now. Okay, and the third step is entering orders. Entering orders is after when you wait for the consolidation. You wait for the consolidation and you see where is the market showing you, or what is the market showing you or indicating, because the market have to show you where is it going, and then after that you react. Okay, so the orders may be pending orders or instant execution. It depends on whatever strategy style that you use, but you can wait for the market to play. If you can wait, you can wait for the market to consolidate and get the candlestick patterns here, or the formation of the market here. The candlestick were showing also here that they are failing, and then the market ended up getting inside here. This on a lower time frame, as I shown, it's a double top. There's also a double top. That's a form of consolidation. That's a form of market going to the same level, hitting it over and over. So that's a form of consolidation. It's another confirmation when you get to that entry. So the entering orders, you either wait for the market to go up, retest, and start to go up. So the orders are gonna be after the consolidation. It's either you're gonna be waiting for your buys, or you're waiting for the market to show you that now it's selling. When you get to this level, it's highly recommendable to not be biased. Why? Because you have to you don't know as an individual trader where the market is going. So the best thing to do is to wait for the market to first consolidate and show you the candles. The candles are going to indicate where the market is going, or where the market is indicating to go. And then after that, that's when you can execute your orders, or you can place orders. And when the market gets to those orders, the market is going to activate and you are going to be in profit. And okay, the first step is implement risk management. That's very important. You don't just execute your orders. You have to also remember that if you were thinking that the market, when it gets to this point, this resistance is not going to hold much, it's just going to break and continue to go up, and you take your buys, remember that the market came here and failed to go up and started going up, even though this buy was going up, promising that even when it gets here, it can. So anything can happen when the market gets to the zone, to the key levels. So what you need to do, don't be biased. You don't become biased, because if you get biased, you are not going to be able to change or whatever that you need to do. But what you need to do is to wait for the market, and after waiting for the market, that's when you execute risk management. You decrease your lot sizes. You don't have to go full margin when you are entering your trades. You don't have to go full margin. Not each and every setup that you're going to take, it's all about flipping your account into 100%. No, you apply risk management, because not all the setups that you are going to execute, even the key levels like this, it can give you a signal sometimes and not work out. So that's something. Okay, the example of a signal that didn't work out. Okay, let's check here. For example, there is a level here which is having like many touch 1 2 3 again, and then when the market came here, it broke. When the market get to this level, it broke. So if you had bought here, or you had come here, let's say you are waiting for a retest, and then you got this hammer candle, it was convincing for a trader to execute here, and then you put your stop loss, let's say you put your stop loss 50 or wherever you put your stop loss, and then you are targeting there. What happened after that? Few hours or within a day, the stop loss was hit. So this is something that you need to take into consideration when you are dealing with the market. Nothing is guaranteed. What you are going to do is only analysis, and what comes after that is what the market decide to do, and we follow the market. So risk management, you have to apply risk management all the time. Each and every trade that you execute, you need risk management. And remember that you ride the momentum. After you catch that momentum, once you get that trade, let's say for instance you found your trade here on this support and it broke out, give you this test here with the bearish engulfing on this point, you execute, you ride the momentum, and you ride the momentum. And after while you are riding the momentum, remember to always protect yourself and to take the profit. The last step is to always take profit. Always take profit when you are trading. You don't hold your trade. You don't hold your trade from this point here. In most cases, a small account, people, they hope to make more. Okay, you don't hold until, and then you come back to the losses again, to your entry here, because it comes with emotions. So you better know and calculate your pips and know when or where are you and when are you exiting that trade, and execute, protect yourself, and take profit all the time, and trade your plan all the time. If you got this far, please don't forget to hit and like and comment, and thank you.